Hey, hey, hey! Here we are. Two scalpers. The Mohawk Forex team are back. And yeah, this is it. NFP day. We're back again. Our favourite trade of the whole month. A chance to really earn some really good pips if you know what you're doing. There's a lot of traders steer clear with this. I don't know how to trade it. We obviously do. Using our Axe trading system, which has had some nice new updates. And yeah, we are plumbed in and getting ready. About 25 minutes to go. Prediction was initially down to 325, a slowing job market. Now they're saying 318, so we want to be a figure below 300 ideally to look taking buys on gold, and vice versa if it happens to be way higher. It even beats last month's 428. Then we could be looking at further sells off on gold, as we see. I've had gold on my chart today. We've had cheeky trades on it. We've had a couple of nice signals as well. And basically it's dropped down to 1864 at the moment. Tight range, trapped in a couple of trend lines, but we're looking for a big break. When the NFP moves, also we'll look at US 30 afterwards. Bit of a slow, it's been a slow descent into hell for stocks again. Still the issues around the world, inflation, Ukraine war, everything is still there. Things really changing, and now everyone's waiting for this jobs market report to see if anything better or worse, or we're going into a decline. And also the same, just after, we've got the ISM manufacturing PMI news as well. The unemployment rate is in there. So again, 1, 2, 3, 4, 5, 4. Sorry, 1, 2, 3. High impact, about 25 minutes. Want those all to sync the same way. Then we've got, just after the open, we've got the PMIs as well. So this is a great news day, great chance to get some final week's pips. Of course, we started the week with a small account challenge, $600, and here we are sat on resolution in the war in Ukraine could help that. Also, a gradual phasing out of the China zero COVID policy could also help that in terms of limiting the disruption to supply chains. But we wouldn't want China to open the floodgates right away just because of the implications of demand to commodity processed products that are already seeing elevated prices. We wouldn't want to see markets. We are sat on 1144. There you go. So we've nearly doubled our trading account. Just through scalping, the opens, the odd news event, but mostly doing the opens, using Axe with our new system and indicators we've got price reversal indicators, we've got trend line break, power move indicators, all built into the system that people can choose to use or not to use, along with price action. And yeah, it's been successful to double an account. So today we're going all in with the 1140. So if we lose it, we lose it. That's how you've got to be. This is money. The house money, we're up from 600. The 600 was flipped over from 300 from the week before. So we're already in profit. I've taken the profit out, and basically we're with house money. So we're going to go all in on NFP and see what we can do. Like I said, there's other things you can trade with this: US dollar, yen, GU even, DAX even, everything moves, but gold tends to be the most reliable in terms of moves and spikes. Obviously, you've got to allow for the commissions and spreads, the downside to gold. And what I need to do is remind myself is undo my preset levels, because I have preset levels of take profit when I enter a trade, so that as soon as I get spiked my way, the profit comes off the table is quicker than what I usually click my mouse or my iPad with, whatever I'm using. It's a great little feature. Quick trade on IC markets on C Trader. I mean, this is, as long as you've got C Trader, you can do this. And currently it's set at TP of 80 pips for gold. So I'm going to push that up to
the passive trade at the headline number. The reason I asked that, Nadia, because I knew the answer and I wanted to ask another question.
Maybe I might go 120. Might go 120. That's what I'm looking for. 120. Multiple trades on 120. Count them up. Range. Obviously, no stop loss. We're cancelling our trades as we take them. Stop loss, you just get spiked out. Pending orders, you just get spiked out. You know, and if you take a win, take a loss on the same, so it's totally pointless. You've got to go all in on this, get the direction right, get in, take the profit, get out, then wait for the bigger market move later on. Fortunately, this is the way to trade it. People want to do stop losses and pending orders. I've tried them all over years of trading, and you know, yes, you get some wins, but overall you get losses. Because the market is there, it's volatile. So a lot of traders steer away from trading NFP because the volatility spiking either way scares people. But if you've got a system like what we've got and we're true scalping, then you're minimizing your risk by getting in and out in a short space of trades. That is the way to do it. Been successful, you know, pretty much every month. Yeah, touch wood. So I've just clicked my quick trades to 120, which is 12 pips. So every time I do a trade, if it ultimately spikes that way, I will take the profit. It will automatically close my trade for really good nifty feature on C Trader.
Keep playing by the rules. Keep playing by the rules. Keep coming out with a series of disclosures and say, this hasn't happened, it was meant to happen. This hasn't happened, it was meant to happen. And Lisa, where we end up, does anyone think this deal is getting done? That's the question.
Honestly, given the fact that we've got a $40 share price,
You do NAS 100. Well, but you're better off focusing on one thing, getting in the vibe of it, learning how that moves during NFP. And gold, I'm not a massive fan. I do trade gold every now and then. Some of the guys in the group love trading gold. And obviously if I see an opportunity, a decent setup, I'll take it. Pretty much NFP is probably the only major one I'll trade gold on, because spreads and commissions are all wiped out. It moves usually that much that you haven't got to worry about an extended spread or anything like that. It will still eat that up and hopefully hit your profit.
Let's say it was Volkswagen, Daimler, Renault.
So even on TradingView, the prediction is 325 down from 428. Unemployment rate is also slightly down. Average hourly earnings is a key one as well, again slightly down, so the whole thing's pointing to the downside, which would mean usually for gold that it's a buy. Again, not always, there's manipulation, there's always people jumping too early. Wait for the move. On this one we're going to go in as soon as we get the result. We will miss the initial spike because the market moves before the news comes out. That's all the way it is. It's just the manipulation of the market. But you don't get scared because the initial move is a good move, and then it will pull back on a resistance or support level. Then we can get the retracement and then wait for the market to settle down and then go with a general trend. That's the one. So bumped into as well, as you can see.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta.
Obviously, Elon Musk has been in the news again. See their US jobs report may show again slowing. Obviously, I was saying Elon Musk again has been saying that the market is going to crash basically, and wants to shed 10% of Tesla. So this has affected already pre-market moves, stocks. So it's already, you know, there's things going against NFP from being a smooth move already because of stuff like that. You can see there's the news. Look, it's 10% cut in staff rates. So all this you have to take into consideration. Obviously, even more so if you trade stocks, which I don't do. But if you trade in stocks rather than CFDs, then very, very important. So is this Russia news as well. Got momentum in the market at the moment. Against Ukraine, that's affecting the markets. There's lots of world news events at the moment, so we just don't know how NFP is going to perform. It's got to be a you know, bigger numbers. I mean, last month was very close to the prediction, and it was adjusted as well, 425 to 406. So, but we'll take note of the unemployment rate as well. If that is lower, the private sector and, you know, the public sector have synced. Trade the open, try and go the opposite way, depends on the result again, and then we'll trade the PMI ISM news, and that's it for the week. Here in London, it's a bank holiday. Obviously, it's the Queen's Jubilee. Markets have been shut in London since yesterday. Nothing's reopening back till Monday. So Traded Monday, Tuesday, Wednesday, all the markets. Yesterday we did a little bit of the US, and like I say, we've managed to nearly double our account from $600 to $11. So pretty good, pretty good. So that gives us a good healthy wedge to trade on gold, and we're going to go in on size. Go in one stand 297. Or $10 a commission, crazy. 5 off that. Might go 0.8. 0.8 gives me 80 cents a pip. Obviously, I'm looking at 100 pips. That's $80 plus another 16. So £80, 90. So each trade should get me about $115 if obviously they hit trading 0.8. My margin's 237. That's the what you've got to have spare to be able to take drawdown account. So like I say, I'm dealing with 1100, 237s, a tad on the high side.
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the
7.
and insights.
I'm going to go 0.7. So multiple trades. 0.7. Commission's £3, about $4. That leaves me a margin of 208. So I should be able to get 3 or 4 trades away, clear them out, and then go again. Try that anyway.
When you think space,
30 minutes to go.
one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars...
Gold now just broke our trend line, and we've got a nice little trend line signal. It's just on our neutral support, so that was a nice winning trade there you could have grabbed. Obviously I was away from it, so that was 10 pips already.
Help humanity take its next giant leap.
I'm not entering any trades, like I say, because I'm just waiting.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front row, the best seats in the house for business's greatest minds. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Watching the reversal, as we know, back off in distance.
The Fed, they'll just go straight to neutral. And then I think they're going to wait and see. They don't want to cause a recession. And that's why they're fine going to neutral. That's just taking their foot off the gas pedal a bit. But once they get to neutral and have to get into actual significant tightening, I think they're going to be a lot more cautious.
Megan Green there, the global chief economist at the Kroll Institute from New York City. We are 12 minutes away from your jobs report. Your data looks like this. Equities lower by 0.6% on the S&P, on the Nasdaq down a little more than 1%. Yields higher by almost a basis point. 291.68 on a 10-year. Crude 117.11, up 0.2%. Tom, you know the estimate well, close to 320 is the estimate going into this jobs report.
See that in 12 minutes here, folks. I'll be looking at the usual data, the strength of the economy. I know Lisa's looking at labor participation. Right now, participating with us, Randall Krosner. He's a former Fed governor and, of course, with Chicago Booth School, opening up their London shop and doing good work for Chicago from finance over to economics. Governor Krosnick, thank you so much for joining today. I want to talk about this jobs report, the inflation that is clear, and what it means for a new middle class. Pew Research shows a shrinking of the middle class due to the success of prosperity in America. How flat on their back on this job
10 minutes to go.
is the American middle class?
Well, there are a lot of opportunities for jobs right now. I mean, there are something like 2 job openings for every unemployed worker. That's really quite extraordinary. So there are a lot of opportunities out there. Have all the opportunities been taken advantage of? Is everything sort of equally spread? For sure not. But there's certainly a lot of opportunities there.
But 300,000 payrolls is not fully employed. That is a real job formation number. And I don't need a single point estimate. I know that's not your game. But do you assume in a fully employed America we go back to 175 or 200,000 non-farm payrolls?
Well, we probably go down from where we are. Remember, the unemployment rate is at near 40, 50-year lows. I mean, you're under 4%. We haven't had that many periods of sustained under 4% unemployment. But one of the issues that you raised is about people who are outside of the job markets, who are not counted as unemployed, that labor force participation ratio. That has not gone up as high as it was pre-pandemic. A lot of that now is sort of older workers who would come back in, but for a variety of reasons, including health reasons, are a little wary of getting back into the market.
Randy, how do you look at the noise that we're seeing in the data? Because there is a narrative and there's a data point to back any narrative that you have right now. How do you look through it and get a leading indicator that gives you some sense of where the jobs number will go in June, in July?
Yeah, certainly when there's a lot of volatility and potential turning points in the economy, people can pick out different pieces of data and develop different narratives. And that just comes when when things are a bit volatile. So certainly in this jobs report, we're looking at both
8 minutes to go. Let's have a quick look. We're 7, 8 minutes to go. We're logged on gold. You can see it's in a bit of a range now. Look,
labor force participation.
came back from that high of 1874. Now we're back down again. We've had 2 conflicting signals, which indicates a range. We can do that. So
are you expecting in terms of
zoom in on this?
You were saying that there are a lot of people who cannot come back in for health reasons, for skills reasons. What does that mean in terms of the tightness?
So I think the labor market is pretty darn tight. As I said, we've got 2 job vacancies.
So we're logged in on gold. Like I say, I'm going to be running 0.7 lots of
That's awfully high. And
going
so,
down. 7 minutes to go. So keep watching gold, see what it's going to be. Want it to be away from that neutral resistance ideally, but I tell you, with NSP, with this result, I reckon it's going to. I'm going to mark where I feel it's going to break up. We're going to go up to here if it's a buy. And if it's a sell, we're going to come out of our breakout zone. This is the zones where
Meltzer once took me to task on the tundra of Jackson Hole by saying that we need to sum, we need to aggregate, we need to go macro. In this jobs economy, should we sum everybody together, or do you partition out parts of the American labor economy?
So I think certainly the Fed's point of view, they've got to look at the big macro picture. But as I was just discussing with Lisa, to try to look at what's going to happen, I think you have to pair it into some of the different pieces to see what's happening in hospitality and leisure, what's happening in some of these different sectors to understand, well, is this really a supply constraint or a bit more of a demand constraint?
Why does it matter, Randy, if we have Jay Powell coming out and saying nuance doesn't matter here? At a certain point, even if it's supply side driven, can this be something that they let slide, given the fact that the only tool they have is to dampen demand, and they cannot allow inflation to remain at the level that it is?
Yes, I think I've said to you guys before, regardless of whether it's supply or demand, it's supply and demand coming together, and the Fed owns it. If inflation is high, people turn to the Fed and say, what's going on? You've got to do something about it. Jay can't simply say, oh, well, that's not my fault. I can't produce more chips. I can't drill more oil. That's not a good explanation. You can try to get away with that for 2 or 3 months and say that it's transitory, but after it's persisted for more than a year, it's their problem, and they have to worry about inflation expectations, regardless of what the source of the the increase in reported inflation is.
Randy, are you prepared to call this a wage price spiral? Citi are there. Are you there?
So I think we're not there yet. We certainly are seeing elevated wage increases, but we're not seeing they have not on average exceeded inflation. Inflation's, depending on your favorite measure, somewhere between 8 or 9%, and wage growth has been more in the 4 to 6% range, again depending on your favorite measure. But that's pretty significant growth compared to where we were before. The real worry is that as inflation comes down, as I think it's likely to at some point, not anywhere close to the 2% target soon, but I think it's likely to come down. Are you going to continue to see wage demands in the 5% or so range if inflation is 4%? That can be a little bit tougher, and that's when you start to see a real change in the labor market. If real wages are going up very significantly, or people are demanding very high wage increases,
a nice little drop there.
That's when
Oh, look at that, nice reversal from that neutral resistance, and again bounced on our zone, so it's already, so now we're going to relocate our potential zone to the next level. Okay, it's going to smash that minor support level and go down to the heavier support level here. Nothing on the top side. We're going to reach here.
I don't know how you aggregate this American economy.
My range now.
In a modern economy, working with Krosner Chicago was Gary Becker and Sherwin Rosen, and they said, look, we're different. We can improve. There's a part of an America, John, improving every week, and there's a part left behind. I don't know how you aggregate that.
Left behind and getting squeezed, and Tom, that's been a problem for a long time. That predates the pandemic as well. It's been a big issue. Looking ahead to payrolls, here's your estimate, 320K. Lisa, is there a Goldilocks number for this market?
300, 260.
Perhaps we appreciate.
Is it the headline number that's going to be the Goldilocks number, or is it something underneath? And perhaps it has to do with wages coming in a little bit or not increasing as quickly, or the participation rate. Give us a number, and you'll get 5 different views on what that could mean for markets.
Mike McKee will give you a number in 4 minutes' time. Equity futures down 0.6% on the S&P. On the Nasdaq, down 1 full percentage point. The estimate is 320K. The previous number is 428. The official number is up next.
Two minutes to go. 3 minutes to go. The final candle. You can see the countdown. 2 minutes 4 seconds. The NFP for June. Like I say, if it is worse than expected news, lower, then we're going to be looking for buys on gold. Let's see though. Like I say, there's these other results that, as I just said on Bloomberg, also play an important part. Employment rate.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here.
We're logged in, we're all good. Like I said, I've got some preset levels set already. Commission's going to be 311. Spreads start to move a bit as they all do on P, but you just got to go for it. The move is bigger than any spread. Don't let that put you off. See, it's a bear signal. We'll be coming down to this level here, and we've got what line? God, look at that, 200. We'll get a nice little 50 seconds to go. Look at it flipping around. This is beautiful. What you want to see. This is the kind of price action you see on NFP. Getting ready like a spring. The move RSI is pointing down. Is it going to be a continuation? Is it going to be better than expected, or are we going to hit this heavy support zone? Good luck, everybody. Here we go. 30 seconds to go. Sorted.
flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Seven, 6, there we go. Get ready, let's see what. Oh, and it's worse, better than expected. It is actually better than expected. That sell, that bounce back, beautiful sell, beautiful bounce back. Pull back up on gold. Fly. Gold push down. NFP, there is the spike down. Look at that news. So, yeah, as you can see there. Short, I'm just going to pick out one trades.
I think what we've seen during this period of time is
So better.
Video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
See, let's have a look at gold. Let's go back to the chart. There's your line look. Going to get a push down. 10 seconds already happened, Jonathan. Behind. US 30. Yes, look at that. NFP was a nice buy.
Comes in much better than anticipated, John. 390,000 jobs were restored last month. The forecast had dropped to 318 after that ADP number. The change in private payrolls, even better, 333,000. Of course, both of those are down from last month. Last month, we'd seen 428,000 and 406,000 for private, but manufacturing payrolls come in up 18,000. Those numbers from the prior month down 22,000. We've had a revision lower. So it does look like the economy may be slowing down just a little bit. The
Listen to their bullshit revision.
At 3.6%, we had anticipated in the Bloomberg survey it would drop to 3.5%. In part, that may be because the labor participation rate.
I'm going to get back in again. Get back in. US 30. Profit already. Up here, look. RSI's good. Power move is indicated there, so you should be buying on US 30 right now.
All that much. It does tick.
Gold. Buy now. You can see. Still in the red zone. Going to push down. Still a bear signal. Had a reversal off the bottom of that. Look where it hit. It hit exactly where I said. Heavy support. This is how good the Axe trading system is. Hit our TP there. Perfect.
By 3 or 4 basis points to 294.
Low side.
TK off the back of this one.
Well, they're not, but I'm going to do some math here, John, and I'm sorry, with the revision up in the last 60 days, John, we've created an average of 413,000 jobs per month. And I'm sorry, it's a job formation machine.
Neil Dutter of Renaissance Macro calling it Goldilocks-ish.
Yeah.
Mike McKee, does that resonate with you?
Unchanged. So yeah, what you had there was
good way you could describe it, given the situation. This is only the
payrolls 390 and 325, so better down from last month, but still better than expected because it could have been under 300. And in the private sector as well, unemployment rate was about as expected. Hence why we're getting this buy on US 30. Look at it fly, beautiful. Hope you guys grab something on that. Really good one.
Change that we have seen in terms of the employment data seems to be in leisure and hospitality again.
See what gold's doing, ranging around, quite dangerous at the moment. I'm going to take my next moves on this.
Now, of course, we're getting into the summer season when there would be more people going into the leisure business.
That neutral resistance, as you can see.
Parks and things open up, so there'll be some seasonal questions about that. But professional and business services still are number 2 at 75,000 higher.
It's 1864.
Maybe starting to take on some part-time workers or contract workers to see how it goes.
Should have gone to US 30 this time, really. US 30 was really, really good, really smooth. And straight up to our breakout zone. Perfect. Eyes on 30.
Of the shift from buying in person to buying online. Construction 36,000. It had been unchanged in April. So
Remember now we could do the reversal
in the month
on the open. So we still got 50 minutes of the moves here. Look, let's just see what's happening. Gold's reversing again. See what we can get. Anything like I set my levels. 20. He's going to push down. Must have given me like 3-4 positions. It did.
An upside surprise in wages. You have seen a tick higher in the participation rate. And when we spoke to Ellen Zettner of Morgan Stanley, I said, pick a number, any number. I can give it you.
See RSI is 39. Down.
Just a little bit of a lift there, Tom. It's not a massive move. It's not dramatic. But if you were sitting here and you were the Federal Reserve, what you'd like to see over a series of months was just for that supply side story to improve, Tom, without that inflationary experience being exacerbated by much time.
Pushing, beautiful, beautiful, beautiful.
Rounded up here, you go from 292 to a 295 10-year yield. You're on your way back to that 3% number.
All of a sudden, with
Nice, we've got a 49.96
now on the week on a 10-year Treasury, put together with what would happen with a German 10-year Bund, which is up about 30 basis points. It's been a big week for yields.
Randall Krosner with us for some observations here, of course, with the Booth School of Chicago, the former Fed governor. Randy, I want to talk about what the Fed actually does around the table at the end of the
100
report. Do they value an analysis of the inflation-adjusted wage? Does the real wage matter?
Sure it does, because they're looking both at the inflation to see
it's going to hit our breakout zone.
What is happening in the labor market, and then they look at adjusting for inflation.
It's going to break the support level and go through to the next level of support.
We've got inflation that's much higher than the roughly 5.5% growth of wages, and so
Brilliant.
I think, as you were saying, the Fed is going to take this as this is kind of what we were anticipating.
Dropped it down to 0.56 and I got in on a smaller lot size as well, so that was a good.
I mean, these are still very strong numbers.
Results, nice levels on gold.
An extremely strong number.
See if we can go in again. Let's wait for it to break this level here. We're seeing is now reverting back. Our move, downside.
So I think it's very much consistent with the Fed's forecasts, and so that means there's nothing that's going to stop them from continuing this march of 50 basis point increases. And as my former colleague from graduate school, Lael Brainerd, said,
nicely. Like I say, if you missed the initial move on NFP, it doesn't matter. You just catch this move all the way back. Catch the reversals. That's what you have to do.
Credence to the idea that they could go 50 basis points, 3 meetings in a row.
Remember, we're using a small account, so.
Point rate hike, even though last week some, including Raphael Bostic, were talking about a pause.
See if US 30 pushes down on the support.
You know, as they always say, they're data dependent. You know, we have to see how the data come. But if you get reports like this, it's going to give Fed the confidence that they are doing the right thing, that they're starting to have a little bit of an impact on inflation. And hopefully, once they get in the 2.5–3% range, they'll have more of an impact. Inflation expectations have not gotten out of control. The short-term expectations are super high, but that makes a lot of sense. But the intermediate to longer-run expectations are really not much out of the range where they've been over the last decade. And this is why the Fed needs to act now. And this is why I think Lael was out there saying, you know, we're going to be tough on inflation.
Brilliant. Yes, we've got all the sales on US 30. Perfect, perfect. We've got 10, 10, 10, 10. Beautiful. Again, small lot sizes, because remember, we're on a small account. That was good. Sell US 30.
Inflation start to come down. And then they'll be
Effect. It pushing down. Look, even more now. Reversal. Good news didn't last long. And gold went down to our heavy support zone. Look, bouncing off that.
Chicago Booth School. The conclusion for him: the Fed has got more work to do. The story for us, equities not really changing off the back of this, down by 0.6% on the S&P, on the Nasdaq off by about 1 percentage point. Yields higher by 5
we can do. Oh, brilliant! What a yes! What a move on gold. Jumped in on that. Took 4 positions. Oh, what do we clear? We cleared 70, 70, 140 to $300 there in 10 seconds. This is true scalping, team. This is how you do it. This is how you do it. Look at that. Thank you, Axe. The Axe trading system gave me that. Beautiful. That's how you do it. Saw that red candle, jumped in on that move, and look at it, straight down to our heavy support. Now you got to wait for the buy. That's brilliant. So that's really good. That's took us to nearly 1,500 with our account, so I'm well happy with that. Absolutely smashed it. Small trading account, 600 to 1,500 in a week. And like I say, thanks to NFP, heavy support now. We've still got trades to go, remember. That was great. We risked everything there to try and get that. That was a great win.
For the inflation story, the biggest
Load up those
number that we get out of the payroll report. Obviously, there's average hourly earnings as well, and that avoided a negative disappointment in terms of fast print. I think the market this morning is maybe reacting on the headline. Yeah, there's a pretty big drag to that headline number from retail. So if you discount that, this was actually a little bit stronger report. Perhaps that's what we're seeing in terms of the market. And as Randy just said, take a step back, 390,000. This is still a very, very strong and too strong labor market. So we need to see that slow. And that's in the
10 minutes of scalping. That's how you do it.
Maybe a little bit of disappointment in terms of the slowing. I wouldn't read too much into
Beautiful.
it. And to your question, Tom,
Gold, I told you, would be the sell as the news was better than expected, even though it was down from last month. And that's what happens. You just got to trust in your analysis, stick to it.
But you can't get the Fed really out of
There was the drop. Now it's going to reverse off the heavy support, of course. You just want to be very careful at the moment. But look at that. I set that level. It broke it perfectly.
It's going to be a very
another great win.
To be thinking about, bonds in the portfolio as an equity hedge, bonds as
for the Mohawk team.
Source of income and preservation of principal, because they've got to adjust. Now the good news is there's been a lot of adjustments, so I think the pain that we've seen in the first quarter unlikely to be repeated, but too early here on this report to say it's all clear.
As traders parse through the numbers, you are seeing a bit more of a lift to yields priced down on bonds, to your point, Jeff. And you're also seeing stocks get hit a little bit more, perhaps because it is still too hot.
That's exactly to where I said.
So how much
put it around that heavy support.
To be faith-based in terms of pick your
say if the news had been,
confirm it, and how much is that sort of what you're feeling right now?
way worse than we would have seen a buy better, see the sell. So gold goes the traditional way. If you mark out there was the entry point here, look, then obviously you get the little flick up as you do the market manipulation. That's why you don't do pending orders, and then there's the sell. So it went perfectly our way.
May not be patient. One comment from Bostic, and everybody says, oh, it's okay, they're going to pause, and then Brainerd tries to put that back in the bottle. So really we got to focus not on being sort of yanked around by various comments, but understand that the priority here is inflation, and that means a consecutive set of inflation prints monthly. So we've got to really follow this over the course of the summer into the fall before we can really definitively claim that the projections, the faith-based projections and the consensus expectations are actually being realized.
Jeff, it's a chart that we have tattooed to our brains, and certainly you do with all your work at Carnegie Mellon. The 10-year real yield, the inflation-adjusted 10-year yield, however you want to measure it, we're nowhere near back to normal, are we? What is your measurement of normal, given these uncertain times, that the real yield has to get back to?
Yeah, it's a great question, Tom, because it really is kind of the North Star for thinking about Fed policy. The Fed wants to get back to neutral. What is neutral?
On that heavy support, pushing down, wait for the next break. You can see we've got our next blue zone already in there. But you get with the Axe trading system, all the zones are provided for you. You just got to follow the rules.
And decrease in inflation. And if
As long as you know where the minor and the heavier support and resistance levels are, that's where your ultimate TPs are, NFP. I set them there, and if that's what you want to set as a long term, like I set 120 per trade, hence me getting $300 there, whatever it was, $350, whatever, in 10 seconds. Or you can set it longer. That's your risk management. That I don't advise on that. That's totally up to you. But there's enough tools on the axe here to tell you where to get out of the trade, which is, well, getting in is the easy part. It's getting out the trade, knowing when to get out. See, we've got a bounce up of the support. Let's have a look at what US 30 is doing, and that was a nice. And we'll class that as that's the NFP. There's your spike. This is the thing with US 30. Remember, there's a lot of negativity still around the whole market. So it was just a little blip, a good news blip that, okay, it's not as bad as what we thought. Now we're going back to where we were 15 minutes before NFP. And that's what you see with stocks. That's why I don't tend to trade NFP with it. It's a bigger machine to kind of turn and move when it's against the news and everything else that's going on. But there was NFP, there's your NFP spike, and if you'd gone for the buy, that would have been a legitimate trade. If you took the buy there, look, you could have grabbed in excess of 80 pips with spreads and stuff and everything. And if you got it wrong, you'd have got a win on the sell. And now I jumped in on that sell there, just grabbed that. There's always a reversal, reversed perfectly off our neutral daily support, our pivot, new line. Again, so if you knew this was going to be better than expected news, you could set your TP just below that neutral distance and let it fly. Me, I just went for 10 pips, not greedy. But this is what you can do with the system. And we had 3 crosses, which are 3 power moves. There's your final one, a power move to the downside. Power move cross, syncs up to the trend line, trend bar that we've got, syncs RSI, then you take the trade. So cross, red trend bar, red RSI, it's a sell. Neutral green, cross, it's a buy. Again, buy. Here, look, red, sell. It's NFP on US 30. Let's have a look on gold. Now pulling back up. Back into our zone.
Is tangible. The dollar strength highlighting this fear that the U.S. will be able to move
done.
well ahead of other central banks.
Once you get to 15 minutes after NFP, that's it. Move is kind of done.
Actually sell off more. Basically, that perhaps the Fed will look to some guidance from the fact that wages have not increased more and say we can hold off and allow inflation to pick up more on the back end. That is sort of the subtle message under the moves, Tom.
She just spoke with Elon Musk. We now speak with Gina Martin Adams, Bloomberg Intelligence Chief Equity Strategist. That was a joke, folks. Mr. Musk has had an eventful 24 hours. Gina Martin Adams, how do you and your team write equity with the buy part of a booming airline business and retail flat on their back, and there's 14 other sectors as well? How do you address that for Monday morning?
Well, I think what you want to really focus on is a few things impacting the equity market. First, the rates reaction to the employment market. The employment report is the most important thing that you want to watch. We are clearly in a market that is being led around by the bond market. Valuations have been responsible for the entirety of the S&P 500 correction so far, as earnings are still growing. That tells you a lot about what's really driving the equity market trend. But as far as the consumer, you allude to airlines versus retail. It's very normal at this stage of the cycle, frankly, as rates start to rise, for the consumer to transition to spending more on services and less on goods. The goods companies are under even greater pressure because that's where a lot of the operating margin weakness has emerged in the index over the course of the last few months. Nonetheless, as long as the consumer is still spending more on services, as long as the services companies are experiencing an acceleration in revenue growth, that does help to shelter the consumer space from what is a pretty difficult environment right now.
Gina, you say that it's been the bond market leading around equities, and that really has been a narrative out there and dominating a lot of the discussion. However, Credit Suisse's Jonathan Golub came out and pointed out that actually the fundamentals have also driven the narrative in terms of tech companies underperforming on earnings growth substantially year over year. How much is this actually a fundamental story of weakness in specific sectors, even with strength in others?
I think it's really a relative story, Lisa. Tech company earnings are still rising. They're just not rising at the pace that anyone had anticipated coming into this year. And that's the point that I'm trying to make when I talk about the bond market really driving the equity market. Yes, on the earnings lines, you have had negative revision momentum emerge over the last couple of months, and that's absolutely created further downdraft in the equity markets. But what's the sort of proximate cause of the sell-off is most certainly rates. I mean, if you look at long duration versus short duration stocks, we've seen this massive divergence in equity performance emerge because of rates. But yes, the economic situation is certainly driving some question into the earnings outlook. Most of it is emerging in the margin lines. Tech has been under pressure from rates, now is under pressure because we're questioning the long-term growth
It's
prospects
ranging
for the
around
space.
heavy support, not taking a buy, not taking a sell.
Happening. And
RSI needs to be well back into that neutral zone to be a confident buy at the moment.
so negative that we
It's
actually
ranging
see our
around,
contractual
dropping
earnings.
back,
The
so it's
proximate
just
cause of the
left
equity
over
market
from
weakness is going
the
to
move.
still
So
be what's happening with rates. Maybe we transition to a point where growth is really the problem for the equity market, but we're just not there yet.
Gina, I talk about it, but
the
you're a
revision
seasoned pro who's actually done this.
track 22 jobs in prior
And
to
guesstimate how rapidly corporations will cut expenses. What about this cycle? What about
employment
this
rate at
time?
3.6. It's about as expected. That's totally fine.
They will, if and when it is
So
necessary.
it was really good.
Just
Nice
not
wins.
necessary yet for most industries. I think if you're going to see cost cutting occur, it's going to be in the goods focused industries, most likely in the
70,
retail space
40,
first.
280,
Maybe some of the durable goods
90,
companies in the industrial
300,
space,
310,
where you'll see
320,
financials might start to see cost
60,
cutting, and then I would look for tech as well. But generally, companies
380,
are very quick to cut costs when
90,
necessary. In anticipation of any margin weakness.
440. So we made $500. There you go, $500 in 10 minutes trading.
And yet, operating margins are still rising year over year as soon as the third quarter and going into the fourth quarter. At least that's what the forecast implies. If we see downward revision momentum to operating margins start to really pick away at that forecast, if we start to see the forecast for operating margins move into negative territory into third and fourth quarter, I think then you'll start to see companies really announce more cost cutting. But on the other side, let's think about what creates that margin pressure. Two things have really created the margin pressure for companies so far this year. The first is China. The second is Russia and Ukraine. So if we do have a reopening of China and some resolution of supply chain constraints, that can ease the margin pressure materially.
Looks like we're headed back down to retest that support zone.
Hey, how you doing?
What's up, brother? I can't believe I've slept through NFP. My apologies.
That's okay. It's early.
Gina Martin Adams of Bloomberg Intelligence, thank you for your insights. And we move from
Yeah, we had some good wins. Yeah, we took the sells on gold, buys on US 30, and then we caught the sells on US 30, but still no buys yet on gold. Still dipping, a little bit of a buy, but still RSI still looking back down again, 26.
And yet not enough to
Just
stave
a
off
wait.
more inflation over the long term. Is this just noise, or do you think that the market response after parsing through the data is important?
Yeah, I do think it's important. And the fact that we're actually outperforming, or I should say underperforming, yields are a bit higher than you would expect given the relatively modest payroll beat, because it's less than a 1 standard deviation beat. So we would expect somewhere more in a 4 or 5 basis point move in the 10-year yield, but 6 basis points is kind of right there. But I think, Lisa, when I look at this data and I look at aggregate labor income, so the number of people employed and plus the wage gains plus how many hours of work, we actually are still growing that at over 9% year on year. And that means that you're going to have a sustainable kind of labor input push to inflation. And that's one of the reasons I think you have this reasonably decent sell-off since the number.
This is really important, folks, and this is why Ira Jersey is thrilled to have at Bloomberg. He goes to the absolute heart of the matter. Ira, let's state it again. It's so important. We're having all this bow tie Wall Street angst, and the fact is income is growing, right?
Yeah, that's exactly right. So people are focused on the wage gains slowing a little bit, and maybe that will keep
Now,
the Fed from
I'm just
hiking quite
waiting
as
now. We'll
quickly.
wait for the open.
They could be right in the
Don't like to buy too much because I want it to go reverse on the open. It doesn't always happen, but we could get a nice pushback up to this 1867, back to where NFP started. Basically, that's what usually happens, back to 1864, 65 zone, and US 30 also.
12% increase in the wages just
You know, again, with the world news and everything that's happening at the moment, we just don't know if that was good enough to make this up. It's not going to hit that heavy support, so probably no. I'm probably going on US 30 on the open rather than gold. So we'll see how it looks as we get nearer. Got about 30 minutes yet, and then remember we've got unusual because of how things have been scheduled with the holidays and stuff. We've got PMI news coming up 15 minutes after the open. So again, markets will be waiting for this now to see if that backs up the unemployment rate.
Bond instability as nominal GDP comes down. We had this complete fluke, double-digit nominal. We knew it had to end, and I guess it's coming down. But do you have a number on nominal GDP where things, not to be Lisa-like, but fall apart?
So not so much. I mean, what we're looking at quite a lot is really the illiquidity of the Treasury market at this point. Because on June 15th, we start to get the very first bonds that run off the Fed's portfolio. So as opposed to the economic situation where you have nominal GDP slowing, which is certainly the Fed's goal here in hiking interest rates and trying to get inflation down.
Yeah.
It's not the real growth story; it's the nominal growth story. But on the other side, you have a market that might not be able to kind of withstand some of the runoff that we're going to have. So you're going to see significantly higher volatility, I think, in rates markets. You've already seen it. Think about how many 10 basis point per day moves we've seen this year versus the last 10 years. It's been quite a lot.
7 basis points now out to a 298. We're on the 3% watch in the 10-year. Lisa, may we remind the animal spirit of the American economy is published is 10.6% up. That Q1.
This is a really strong economy. And I'm sitting here and I'm racking my brain to try to really dovetail the idea of really the depression that a lot of people feel and the sort of sense that there's going to be a downturn with the incredible momentum. And that is really the incredible argument that I see on Twitter and elsewhere among economists. How can you be talking about recession? How can you be talking about a Fed really torpedoing this dynamism given the fact that this is an incredibly strong economy? Ira, do you get the sense that that is still likely, that there is going to have to be a measure taken by the Fed to create more weakness than people are expecting? Or do you think that perhaps the pessimism has gone too far?
Well, I do think that the Fed has to push us into recession. The only way for us to get a significant slowdown in inflation and these price pressures is to reduce demand, because a lot of what's going on in the economy right now, and one of the reasons for some of the higher prices has started with supply chains, and we all know the narrative. We've been talking about it for the better part of a year now. But it really is that the Federal Reserve has to push us into a recession, at least in terms of real growth. But like Tom was implying before, and I completely agree with this, is that we really need to get nominal growth down. So it doesn't mean that we have to have a very deep recession, right? But we do have to have growth slowing on a real basis in order to get nominal growth much lower and for inflation to come down to more reasonable levels. And it's going to take years. Like we don't appreciate this, but we're still going to have 3+% inflation through 2023. And that's not an environment where the Fed is likely to be cutting interest rates, even though Bullard and some others think that they might be.
Brilliant. Ira Jersey, thank you so much. What a primer with Bloomberg Intelligence this morning. Lisa, I can't say this enough, and I can't wait for Michael Darda to publish off of this report today with MKM Partners. To me, the heart of the matter, witness American Airlines today, and I understand Lisa, you got to get on a plane this weekend and fly down to Atlanta to sit in the airport for the weekend because of thunderstorms. But the answer, Lisa, is it's a boom economy. And as Jersey just said, the solution is the x-axis gets extended out far more than the tantrums of the media.
I like your hand motions. It's really good on radio.
It works great on radio.
What Ira was saying, though, is we could still have a boom economy on a nominal level, but on a real level, we need to see it decline. This is important, right? Because people are spending more money because they have more money. This is just math, right? I mean, when you see inflation, people are earning more, things cost more, then there's more money in the system. At what point does growth slow substantially enough to stop the pace of price increases? And that, I think, is really a hard message to create in a world that does not deal with nuance very well.
Futures deteriorate, -42 Dow futures, -232, and the VIX out of stick, 25.64. We are on the 3% watch and the 10-year yield. That will be, is that something that Marty Walsh wants to talk about? I don't think so, but Bobby Farrow will cram it in there if we get a 3% print on a 10-year. John Farrow with the Secretary of Labor. Look for that coming up on radio, on television. This is Bloomberg.
Yields up, stocks down. Live from New York City this morning. Good morning, good morning. The countdown to the open starts.
Countdown is beginning. There you go. See, look, and gold's back down again. That's why you don't take the buys.
Start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, the data providing something for everyone.
This jobs report.
Even if we see those headline numbers roll over,
The labor market is too tight.
This is where we see the overheating of the U.S. economy happening.
It is inviting the Fed to tighten policy substantially.
This is where obviously the Fed tries to slow down things.
They do need the labor market to cool.
It is generating inflationary pressure.
The Fed needs to loosen that up, or wage pressures will accumulate.
There's still not signs of significant slowdown in the labor market.
A cool off in the labor market would be a good thing.
You're trying to guide unemployment up.
The data will give the Fed wiggle room.
It just takes Fed rate hikes quarters to impact the economy.
We're in a difficult situation.
Unfortunately, when the world's uncertain, we just have to admit it.
With your jobs report, let's get to Mike McKee. Morning, Mike.
Good morning, John. Good news for Jay Powell. He's got to love these numbers. It suggests the economy is slowing down without going into any kind of recession yet. 390,000 jobs were restored during the month of May, and we lost 22,000 in revisions. So it is a little bit better than we anticipated, and that's good news for the Federal Reserve. Unemployment rate stays at 3.6%. That's also good news because they're supposed to be pushing up unemployment. Unemployment did not rise, but it didn't fall either. The participation rate is up a tick at 62.3. Average hourly earnings fall a little bit. They were up only 0.3 for the month, so that puts it at 5.2% for the year. And that is also a sign of maybe slowing inflation pressure. You can see the categories that mattered: leisure and hospitality still adding back jobs. Professional and business services, maybe people are hiring contract workers
That's where
right
jobs
now.
are at.
Retail, the big loser, down almost 61,000 jobs, but that was offset by transport and warehousing, 47,000. That's a category that shows up when Amazon hires a lot of people for warehouses, etc. So it could be a shift in the mix of employment in the retail kind of category. So that leaves us now with this question: where do we go with inflation when unemployment is staying steady and not rising? You can see there that it has been pushing the inflation rate, the PCE inflation rate, up by with the higher earnings. And now if that falls off, John, things could be a little bit better. You used the term Goldilocks earlier. Maybe Jay Powell is Papa Bear here.
Mike McKee, thank you, buddy. I'll leave that one. I'm not going to use that term. Mike, wonderful work as always. Yields are higher on a 10-year by, let's call it 7 basis points to 298. In the equity market, we're lower by about 1 full percentage point. I didn't use the Goldilocks term. I used Goldilocks.
Still 390, still good result.
That belonged to Neil Dutter of Renmac. He went on to say that
Hence why I'll be interested to see how US 30 responds to this on the open. Had that spike, good news, and it's pulled back to how it was. Like I say, previous, you can see the trend there.
At some
Now it's below our trend line as well. It's in our channel. You can see this new channel we've got, trend line channel. Smaller moves. We'll see if it pulls back up. Our trend is red, as you can see. Look.
Quite frankly, I think this is the last solid report you're going to get for a long time. If you look, I think what Mike McKee just said, I think was pretty interesting. But if you look at what the trend is, I look at these high frequency cyclical indicators, retail obviously being soft, but leisure and hospitality, business services, the trend is coming down. I mean, when you obviously hear from Elon Musk, you hear from Amazon, you hear from the big tech companies, the trend is definitely decelerating. We have made the turn on employment. And I think today was the last, when you look at the top line headline number, that was solid, because it takes a bit of time to transition. Things like education are still strong and will stay pretty strong. Listen, the levels are pretty good. The Fed, this will do nothing to deter the Fed from where they're going. But I think it's a big report, because I think we're now going to make the turn. I think the next 3 or 4 months, you're going to see these numbers decline. I could see a negative print over the next 3 or 4 months. And that's the thing that I'm keyed into. And I think that's what markets will react to and try to interpret how deep the Fed's going to go in bringing employment down, bringing the demand function down through the employment channel. And I think that's going to be a big deal for markets.
Hey, Rick, this is a big call. You think this is the last good one? Over the next 3 months, we could get a negative print. What's leading you in that direction? Why do you think that?
Well, I did it in one of our strategy meetings. I read all the companies. I mean, it is a lot. I don't have it in front of me. It's a long list of companies that are freezing hiring and or cutting staff. And it is a persistent across big tech, across some of the rapid areas that you've been seeing, healthcare. You're starting to see, and by the way, then the correlated issue to that is you're seeing restaurants. I mean, I follow the restaurant sector pretty closely, and you're seeing that all of a sudden, boy, you couldn't offer delivery before, now you can. And now the availability of labor is really improving. I mean, almost across every sector, you're hearing companies talk about, we can now hire, some of the very specialized skill areas are still going to be hard. Biotech's hard. But boy, you're seeing availability of labor. There's no question in my mind we're making a turn. And the question is how deep it is. And then, quite frankly, how much the Fed is going to lean into this to try and bring down inflation. And I think that's going to be the critical thing for markets.
And so, Rick, that's the economic analysis. That's your opinion, your view, made up by what you've been reading. Push it through this market. Yields are higher today, equities are lower. What are you doing?
So, I'm in the same camp that I've been in. Well, actually, I would say changed a little bit. And, we've been talking about for a number of months. Cash is a good asset.
US 30 now ranging, just trapped on that heavy support. Again, not taking any trades at the moment.
You've priced in 50 basis point hikes for the next meeting, 50 basis
good.
Points for July, and then 50 basis
Say we did
50 basis points for September.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 trades on NFP there, and all winners. So, nice.
To go. So we're keeping our interest rate exposure moderate relative to that. But for the first time, Jonathan, since the last probably this year, last few months, we've been talking about this. You have to think about the Fed's tightening financial conditions. That is the title of the book, and the conclusion of the book will be they will have done that. The chapters are interesting in between, but that's where we're going. But for the first time, you're getting yields back far enough in some of the credit sectors. So we started to add some high yield. I know I've been talking negatively, or that we didn't like high yield for a while. We're starting to add some pieces. We have been. And so, but I think you could be slow. I think you can be deliberate. I think you're still going to see rates move a bit higher. And listen, the title of the book is Financial Conditions Are Going to Be Tighter. And that's how the Fed, one of the channels the Fed's going to use to reduce demand and bring down inflation. So,
Rick, as you position in high yield, just a little bit, I don't want to overemphasize what you've just said, but as you do that, are you basically telling me you can't expect too much spread tightening from here? Because if you do, that's an unwarranted easing of financial conditions because this Fed doesn't want them there?
I couldn't have said it better than you did. I think, listen, I think that's right. I think you're going to hear, as you get, employment data be a bit softer. By the way, you look at net disposable income, you're seeing the wages component, certainly the rate of growth slow. And then you think about what is the true consumption that individuals, it's, gosh, I've got higher gas prices ahead of me. I've got higher food prices. I've got higher rental rates. So net disposable income is coming down. Consumption is going to slow. So people are going to say, gosh, we're going into a recession. I actually don't think the U.S. is going into a recession. I think Europe is sliding deeper into slower growth. China's obviously in slow growth. So I think you're going to have to be careful about high yield because people will get worried about that. Listen, I don't think we're going to a recession because the starting point on all these things is really strong. I mean, the employment numbers are going to slow down, but gosh, if you said 390,000 employment top line payroll 3 or 4 years ago, you'd say, wow, the economy's strong. It's just we're decelerating. I don't think we're going to a recession, but I think people worry about that. Markets will worry about that over the coming weeks and months.
Where does this leave equities, Rick, for you?
You know, I think they're okay. I don't think they're. I mean, I think they're. I still think they need to back up a bit more. Listen, I don't think when you do. I always value equities based on what is your cash flow relative to your cost to finance it. That means where are the credit markets, where are yields, and if yields still have some upward drift, if credit is still maybe got some upward drift, I don't think equities can make a significant upturn yet. But are there? By the way, there's some areas. We've started to pick away on some of these areas that I think have come under a lot of pressure under the cyclical framework is coming out as being softer. So I still think equities. I'd rather, quite frankly, start buying yielding assets into the portfolio before taking a lot of equity beta risk. The one place, Jonathan, that I think is really interesting. I know I talked about. I think Jamie Dimon's the same thing about we're in this hurricane of financial conditions. People buy a lot of insurance during hurricane. I like selling during hurricanes. I like selling volatility, selling some downside on equities as opposed to taking a lot of. Gosh, I want to take a lot of equity to what we call Delta 1 or beta risk today. So a bit more moderate, but sell the downside. If people want to buy insurance on we're going down 15% in equities, I'd rather sell that.
You mentioned you did like a place in the equity market. Rick, you didn't name it. Where is it?
Okay. So, the place that I think has gotten overdone, there are a couple places I think have gotten overdone. I mean, and by the way, had a huge run yesterday, was like software. I mean,
30
some of these
pushing down again, as you can see, back down. Heavy support.
From Salesforce.com, Dynatrace, etc.
Still 10 pips there.
Companies are cash flowing really well. The multiples have come down a level.
Everything's red.
That are, are
down.
Not, if you're growing 30% organic top line growth, forward multiples of 2025 are not for those types of growth engines. So I think that's interesting. Again, I think you have to be a little bit careful because people worry about recession, so you don't go all in. I think some of the autos
a nice sell in there.
Listen, I still think energy.
So we're close to the open now, so I've got any trades. Just sit as much as I'm tempted. This is the whole thing. Just got to sit on your hands.
Still a good hold. And I think some of the industrials have gotten
up our lot sizes now on
Listen, I think tech
32.
Because we're cyclical in rates, and by the way, today could be a good day. People worry about rates moving much higher, and then so I think some of those areas are worth. Again, I don't think it's worth going all in yet.
Rick,
and by the way, it's in the same framework of where do you sell the downside? If people want to pay huge levels of volatility to sell you 15-20% down from these levels, that's a pretty good place to get into some of these names, or at least get some fee into the portfolios.
This is a super nuanced view from you, Rick, and I appreciate it. Thanks for your time, buddy. As always, Rick Reeder there of BlackRock, just breaking down the equity market, the bond market from his perspective, where things are going. Where things are going right now, equities lower by more than 1% on the S&P with your movers going into the opening bow. Let's get to Abby.
John, well, front and center to this morning's bearish tone, of course, the shares of Tesla down sharply. This as Elon Musk, CEO, of course, of that company, suggests that Tesla may need to cut staff by 10%. That would equal almost 10,000 workers. This in an email seen by Reuters titled, "Pause all hiring worldwide." Elon Musk in the email says he has a, quote, super bad feeling about the economy. So really in agreement with Jamie Dimon of JP Morgan, and really in line with what Rick Reeder was just talking about too. Now, relative to Rick talking about Apple, or tech, I should say, overall being relatively on sale today, well, there you have it. Apple down 2.6%. This, of course, as yields are backing up from that jobs report. Alphabet also down 1.1%. And software, Rick was just talking about software. Take a look at Asana, down more than 8%. This is a collaboration software company. They beat in the last quarter, but their guidance for the future quarter not great. Analysts concerned about margins and a big cash burn. There is a 27% bearish short there. Interesting, though, John, you do some work on it. Maybe there is something interesting to look at there on the shares of Asana, but overall, bearish open here.
Abby, thank you. Coming up on this program, warnings from the C-suite piling up.
This is among, if not the most complex
dynamic environment I've ever seen in my career. The confluence of the number of shocks to the system, to me, is unprecedented.
From JP Morgan to Goldman and now to Elon Musk of Tesla, that conversation up next.
Up next, we've got 15 minutes to the open. You look, as I told you, bounce back off that heavy support, dip in and retest it. And we're going to get buys on the NFP bounce again. And continuing slides. Being forwards, wait for confirmation on the RSI before we jump in. And then, like I say, we've got 15 minutes until the PMIs. Last one, 3, done. Trading week done. So far looking good, like I say.
Now, they're getting hundreds, maybe even thousands of applications. So software is
10%
coming
plus
in
pay.
to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
I think that it's hard to put your head around any
30 still waiting.
We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy. You better brace yourself.
We certainly expected that we would have a tougher economic period ahead of us. There's no question that we're seeing a tougher capital markets environment.
The warnings piling up. Tesla, the latest. The CEO, Elon Musk, in an internal email, according to Reuters, saying the following. He has a super bad feeling about the economy. A super bad feeling, Kelly Lights.
Super bad. I don't know what the difference is between super bad and just a bad feeling, but either way, that is what Elon Musk is using to justify his desire to freeze all hiring and cut 10% of Tesla's workforce. And of course, John, we would care if it was Tesla alone, because it's Tesla, a huge heavyweight in this market. But the fact of the matter is, Tesla is far from alone. We have seen a laundry list of companies, many of them in the tech sector, making similar announcements about their workforces. Snap, Microsoft, Apple, Instacart, Lyft, all slowing hiring for different groups. Meta freezing hiring for some teams. Coinbase is freezing hiring. Twitter has as well, while PayPal, Robinhood, and Netflix have outright cut jobs. Apparently, Elon Musk also wants to do that now. And all of that added to warnings of a different kind, including foreign exchange rates, which is what we heard from Microsoft yesterday, cutting its guidance for the current period because of a stronger dollar. And of course, all these companies have in common, John, that they are technology companies, those that have been pressured the most by investors so far this year, with the NASDAQ 100 dramatically underperforming that of the S&P 500. Now, for all of that fear, it really is going to come down to the fundamental picture. And the fact of the matter is we are seeing margins hanging in there. In fact, 14.1% margin for the S&P 500 is what estimates are for 2023. But we are starting to see those come down. According to Bloomberg Intelligence, since April 22nd, S&P margin estimates have dropped 36 percentage points for the second quarter, 19 percentage points for the third quarter, and 7 percentage points for the final 3 months of the year. And our Bloomberg Intelligence senior senior equity strategist Gina Martin Adams says that's probably going to get worse, not better, as these companies face higher costs, including higher wages, which helps explain why some companies are looking to pay less people at all, John.
Katie, thank you. How's this for value add? Do you remember the movie Superbad? Just had a terminal subscriber who messaged me and said that McLovin was born on June 3rd.
That can't be a coincidence.
Just in case you're wondering. I'm not saying anything's going on here, just saying. Katie, thank you. With us now, SocGen Subhadra Rajappa, PGIM's Mike Collins. Subhadra, based on the data, have you got a super bad feeling about this economy?
Not yet, but it's a tale of two halves, right? Like the first half of the year is relatively strong. We've seen pretty strong job growth. ISMs are very strong. The question is, what does the second half hold for us? And really, that's where the concerns are, mostly in the bond market as well as in the equity market, which is, are we going to see a meaningful slowdown in the pace of job creation, if anything? Is this going to lead to a slowdown in growth, as well as, a slowdown in the retail sector? The consumers under a lot of pressure. So that's really what we're focused on here going forward, is sort of looking ahead. What is the data going to show us? And that's really where most of the concerns are in the bond market.
Mike Collins, your take, please.
Yeah, so this is how it works, right, Jonathan? The Fed signals that they want to tighten financial conditions. Sure enough, financial conditions tighten, and they've tightened a lot already, even though the Fed's barely started hiking and just started quantitative tightening. It feeds through asset prices, where we've seen some pretty significant devaluations, and I still believe in private debt markets, real estate markets, you haven't seen yet the asset price hit there. And then it feeds through to consumer and business confidence, right? And I think you're just at the beginning stages, and you're seeing all these CEOs, their confidence is waning, right? There's a little less certainty about the future. So they pull back on big projects, they pull back on big
slowly pushing down to a support zone, which is good, like I say, because if it breaks this, we've got a blue zone here, historic support zone on our X trading system. So again, we could get a nice bounce.
Lower by about 1% on the S&P, down 1.14% on the Nasdaq. Subhadra, this move in yield is interesting.
Everything's down though.
Again, 297 up 6 basis points on the day.
Future slide, so we could get that manipulation where everyone wants to sell straight from the open, and guess what? Market goes against you. In which case we jump in, get our pips, get out.
Your thoughts on what's happening here as yields start to break out just a little bit once again?
Well, the market participants are really pushing back on ECB's gradualism, right? You're seeing very, very strong inflation prints in Europe, and it's call to action for the ECB. They're still saying that they're going to be raising rates at 25 basis points, a meeting starting in July. And that sort of gradualism might just not work for them. And the real concern for the ECB is that they're going to fall behind the curve, especially with aggressive rate hikes coming from the U.S. I think the longer they wait to raise rates, the harder it's going to be for them to be able to raise rates. And that's exactly what the market's kind of pushing them towards, is to act sooner and faster.
Mike, you've got this dual tightening of the Federal Reserve, an ECB that's ready to go, maybe next week, using that opportunity to lay the groundwork for July. A lot of these bullish calls in the equity market, they hinge on a Fed pausing in September. They hinge on this idea that we've seen peak inflation, we've seen peak yields. In Europe, that might not be the case. How important is that to you, Mike?
I think it's really important, right? But there are a lot of these hikes now priced in. Or I think for the ECB, Jonathan, this is like a get out of negative interest rate jail card, right? So they're taking this opportunity to get that deposit rate from negative territory back to positive. But I don't think it's a big tightening cycle in Europe. But there's a lot of tightening priced in. In the US, right, the funds rate that's priced in, the terminal funds rate, has been between 2 3/4 a few weeks ago, all the way up to about 340 about a month ago. So right now it's right in the middle, about 310. So the game that the markets are playing is, where does it shake out? It's a pretty narrow range, and the markets feel like they're pretty fairly valued for this 3-ish terminal funds rate. So I don't think there's a lot of risk for a big move higher in bond yields from here.
Mike Collins, Subhadra Rajappa will be sticking with us. We'll catch up with the White House first on this program in about 8 minutes' time. Then we'll get the reaction of Mike Collins and Subhadra Rajappa to that. It's like the last 8 or 10 years in reverse. Central banks have gone from wanting lower interest rates to lower inflation and a weaker currency to wanting higher interest rates, inflation lower. In fact, inflation higher was the previous 10 years. You get where I'm going with this. And a currency that they now want to be weaker, stronger.
6 minutes to go.
Any of this? We're down about 1% on the S&P. From New York, this is Bloomberg.
Everyone's saying if we're pushing lower, are we going to get that manipulation for first? Going on your 30, we're going to go in 2 standards of this. Logged in, we're all good. So we've got the PMIs after. Include. Will be a bounce. 12.6T. As could be the same as Dow. Yeah, there could be a nice. Actually hit a nice support level. Had a reverse signal. We've got to break our trend line. We have got heavy support at 12.640 area. 12.640 or 12.680. Yeah, that's a heavier support. Also, we could get that reverse buy on the open. Maybe back to our breakout, maybe to 12.733 to 12.759.
Mercedes-Benz is on
Trading as
mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
See.
5 minutes until the opening bell. Equities lower 1%. Here are your morning calls. First up, Piper Sandler downgrading Micron to underweight, highlighting the chip maker's oversight exposure to consumers and macroeconomic trends. Your next call from Goldman, downgrading Travelers to south, 170 price target, seeing little upside with margins starting to weaken. And finally, Cowen trimming its Q2 delivery estimates for Tesla, expecting China's COVID-0 policy to weigh on production numbers. Since I butchered that moments ago, the last 10 years in reverse, we've gone from wanting rates lower to wanting rates higher, inflation higher, now lower, and a currency then, everyone wanted a weaker one, now they want a stronger one. I wish we could edit a live program, but we can't. Coming up, Secretary Walsh from the White House on the latest jobs report. Reaction coming up next from New York.
NY breaking down, look, gonna hit our blue zone. A nice sell again. Again, just not entering trades, no rush, no FOMO. Now's doing the same. Is it going to bounce? Are they both going to take a bounce? Gold, like I say, I'm leaving alone. I've had my fun with gold. See what we can get on the US 30. Any setting. Trade. Pop that. For slippage with the old market range as well. Quick trade. Good thing about C trade. Right. So that we're going to get a bounce. Oh, beautiful. This couldn't be any better for a setup. We're either going to get a complete smash through. DP is going to be around about 328, 988, or yeah, back up. Yeah, what I would like to see. We only had a quick snip of a buy because of NFP. The rest of it has been sell, sell, sell. All the negativity, mostly probably caused by Tesla, Elon Musk, and everything. News on that. The cash is just pushing up. RSI still looking to ditch down, so there's still just don't know
vital it is to the global space industry.
Which way this is going to push.
Collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Go. Got 2 seconds, 2, 1. Here we go. Let's see what the move is. It's 30.
BSO Now is your online home for weekly Boston Symphony.
Oh, look at that. Pushing up, pushing up.
See new concerts that
it's in back off that zone.
plus acclaimed archival concerts. Visit bso.org/now. With a music
a reversal.
BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on
Look.
the we did see some pressure on the futures. That is now being
Gonna get a bounce. RSI dipping down. Sales at the moment just cleared out 2 sales.
25 seconds away from the upward about this morning. Good morning to you.
Down.
Futures just negative by more than 1% now on the S&P. On the Nasdaq 100.
That move, beautiful. Gonna break that zone. Back up.
Through the close on Thursday, we're actually positive on the week. So for
That
a second week
bounce.
of gains.
Nas.
Not so much. Let's see open about
Nas just dropped through the roof, through the floor. Look at that. So a continuation.
Up 5 basis points now to 296.
No reversal.
In the FX market, euro dollar 107.30. We're negative there. 210.
US 30 back range in. Are we going to get a reversal? Come on.
Right now 117.
Get ready.
Up a 0.25%. That's across asset price action with your movers. Here's Abby.
John, let's start out.
We're in. Yes, we did it. Hey, well done. Beautiful. Saw that move. We got it. We got those buys. 4 buys there. We got 15, 20, 20 and 15. So another $100. Quick 100 there. That will do nicely. Again, remember, we're only trading a small account. Only 1,500.
Jamie Dimon, John Waldron, even Larry Fink about the possibility of the economy really taking a sharp downturn. Now, tech is down also with Tesla. Microsoft yesterday getting a pass for that guide down for the current quarter on FX, but maybe it's more on this week economy. This week macro down 1.6%, Apple down 2%.
Just had to hold.
Yields higher on that decent jobs report.
Watch that move. Watch the RSI King Cup. Look, there you go. Look, pushing.
Not even helping out the banks, John.
Now we've got a nice little signal as well. Look.
Down 0.6%, even as yields back up. So a bearish Friday for the week. Let's see whether or not we
Wait for
can
that
get
to
gains on the week.
down.
Abby, thank you. We've got to move to tech as well. There's one man charged with following Elon Musk here on Bloomberg TV. It's Ed Ludlow on the West Coast. And being on the West Coast, Ed, given that Elon stays up sometimes,
44 seconds.
sends out emails and tweets, you don't get much rest, do you?
I'm smiling, but inside it's a very different feeling, John.
Painful,
Look,
Ed.
painful. 2 companies, 2 stocks moving in different directions. Elon Musk.
Brilliant. It's gone over $10 there.
Right. Twitter up 1.6%. The Hart-Scott-Rodino period. It's a regulatory rubber stamping. Twitter has put out a regulatory filing saying that period is passed. Either it means that the set term that was agreed between the parties has passed, or regulators have said to Twitter and the Musk coalition, you are free to proceed with talking about the deal. The stock's higher by almost 2%. We're moving towards a place where we think it's happening. Tesla is the focus, down 5 percentage points on Tesla. I'll remind the audience that the idea around economic uncertainty and recession with Elon Musk is not new. 7 days ago, he replied to a Twitter user, of course, saying that he foresaw a recession that would last 12 to 18 months, but that in his opinion, that was no bad thing. Because
All right, let's see what we can do. Again, nice breakout. Look at that. So
weren't going anywhere, and the stronger ones
the open was bang on, as we said. Reversals, a little bit of manipulation.
and get back into the office.
Perfect open.
After that, the memo seen by Reuters, which was sent to executive staff, says that they will pause hiring and cut jobs by 10%, John.
What do you make of the idea that June 3rd...
Reversal buys going against everything that Bloomberg is saying.
Ed, what do you make of that? Is something ridiculous going on here that we just don't know about?
hard inference to pull, John. I think that
Perfect.
I never thought I'd be doing this on business TV, but here we are, Ed, doing it.
We are. I mean, at the end of the day, Tom Keane just asked me on radio, how seriously do we take the tweets versus the internal memos versus the regulatory filings? At the end of the day...
Brilliant, brilliant. And we've got a load more buys there. We just got another 14, 14, 3 and 6. We've got another about $50 there. Again, on the buys. This is what true scalping's all about, team.
Pretty badly too, down 0.9% on the S&P 500, on the Nasdaq 100 off by 1.5%. On the Russell, the small caps, negative 0.72. From New York City, I'm pleased to say on Bloomberg TV and on Bloomberg Radio, we're joined now by the US Labour Secretary, Marty Walsh. Secretary Walsh, first of all, sir, I know you've been unwell the last couple of days. Can you tell us if you're okay?
I'm doing all right. Yeah, I feel a lot better. It's thank God I'm vaxxed and boosted, because this thing it attacks your immune system. But I feel good, so thank you for that.
Well, you're a good man for giving
Nice push shot. It's just Naz. Beautiful. Naz is about to do the same look. PR possible reversal.
The view from the White House at the moment.
Certainly, it's a good jobs report. 390,000 jobs. We're seeing good gains there. One thing that we looked at from when the president took over, we had 10 million people out of work in America. It was down to 455,000. That's a good number. We're seeing steady and stable growth here in the jobs reports. But we know, as I say every month, we have more work to do. This what outpaced what the expectations were. But
we'll wait for the RSI to go green, ideally, trading NAS. But as we said, that's just a nice little back from that 1260.
1.9 jobs for every unemployed person in America right now.
There's 39 drop back on that resistance. That's fine. We'll wait.
Didn't move lower today, but still a decent level of 3.6.
RSI just gone green.
Most people are concluding has a fair bit of bargaining power here. So Secretary Walsh,
is it going to be a drop now? Here's your own. Again, this is based on the P news, probably. Likely.
Yeah, I think that those conversations are going steady. I've been staying in contact with
PMI news coming up. Market PMI.
Now I think it's on a good pace, and they just need to continue to have those negotiations. Obviously,
got back.
Anytime you have a negotiation like the ports, whether it's on the west or east coast, but in this case on the west coast, we want to keep a close eye, because we know the impacts that if it doesn't go well, what it'll have. But I feel pretty good about. I feel confident where they're headed on those conversations.
Can you give us some idea of why you're confident based on the conversations of the last month, what the developments actually are, specifically?
Yeah, I've spoken to both the companies and the unions, and neither one have really said that there's any obstacles that they're really concerned
Final
about.
trades of the week. I'd say we've done really well. Up to about 1650.
I think all the parties know
600 starts, so well happy with week's performance.
Supply chain issues and what's happened in the port. So I think they also understand the importance of getting a contract done.
Secretary Walsh, just finally, because I know you have to run, we've had some warnings this week from some big players. Jamie Dimon talked about a hurricane coming to the economy. We heard from Elon Musk of Tesla. Reuters reporting that he sent an internal email pausing hiring, potentially cutting 10% of the workforce. Are you seeing much more of that in the conversations you have with corporations week to week, day to day?
No, they haven't really brought that up to me. But I'll tell you, the president has been very, very focused on making sure that we continue to tackle all the inflationary challenges and the challenge of the economy. I mean, this is an all hands on deck approach that includes government and corporations working collectively together. I think that we're kind of like we're in a marathon here. This isn't a sprint, this is a marathon, and we have to just continue to move forward one day at a time.
Secretary Walsh, we appreciate your time, and I hope you get better soon, and we'll get you back in person, hopefully. Thank you, sir. Thank you very much. Secretary Marty Walsh there. From New York, let's get back to this market as well and bring in two special guests. We can catch up with Subhadra Rajappa and Mike Collins. Subhadra, I want to come to you first. The warnings we're hearing from some big players in the C-suite. I want to understand from you where you think this labour market is going based on something...
Waiting now, no point taking a trade because, again, we've got the PMI, we've got a bit of a range that we're bouncing on our trend line. Nice support on our breakout zone. We took that buy, grabbed those buys. Beautiful little move there on the open.
Decline, and the employment numbers are going to slow down. But gosh, you said 390,000 employment top line payroll 3 or 4 years ago. It's like, wow, the economy's strong. It's just we're decelerating. I don't think we're going to a recession, but I think people worry about that. Markets will worry about that over the coming weeks and months.
Subhadra, your thoughts, please.
Well, I think that the pace of job creation has to decline, right? You're looking at a very, very robust pace of job creation all through the first half of this year. So that pace has to slow down. The question is whether we go into negative territory, we start losing jobs at some point, and that might actually be what the Fed ultimately, I shouldn't say desires, but that might ultimately what happened because of Fed policy actions. The Fed's going to be aggressively raising rates by, say, 50 basis points a meeting for the next few meetings. And this jobs report is basically the green signal that they're looking for to continue to tighten policy. So the side effect of that is going to be that you're going to see a slowdown in the pace of job creation, perhaps layoffs, and perhaps a much, sort of less tighter job market than you're currently seeing right now. Job openings are going to come down, and the unemployment rate is going to probably edge up a little bit. But broadly speaking, I think that the labor market is still going to remain very strong. And that's the one part of the economy that I think is going to hold up quite well for the remainder of the year.
Mike Collins, your take.
Yeah, John, as we all know, the labor market's been surprisingly rock solid, but it is decelerating. That pace of gains is decelerating. I don't think it's a function of the economy slowing as much as just running out of workers, right? We're getting back to full employment for sure. So that's really good news. This cycle.
4 minutes to go, 5 minutes to go. And again, the PMIs are looking to be lower. I expect at the moment everything is bearish. Remember, we're in a bear market now. So any improvement on this should give us a buy.
And already now, 2 months later,
US 30 is trying to be bullish. Look, it's doing its best, blessed to push up just a little bit.
the markets change, sentiment changes.
This is going to be interesting to see.
That things slow more quickly than we think.
I wasn't planning to talk about Superbad the movie today. Mike, just to give you the opportunity, would you like to wish them a happy birthday?
Yeah, Nikki, happy birthday, baby.
Do you want to wish McLovin a happy birthday? No, we don't have to do that either. Don't worry. Mike Collins, you're going to stick with us alongside Chabadra Ajampa. Coming up, OPEC garnering signs of relief with a boost in oil supply.
We welcome the important decision that OPEC Plus made to increase supply. The United States will continue to use all tools at our disposal to address energy prices.
That conversation up next, and a happy birthday to Nikki.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Down again, spike up, that news, and then go the open, back down again. Ranging, stuck on our trend line, but again, the trend line's holding it nicely. Got 2 minutes. New candle, form, down, push it up. RSI's in that neutral zone, wait, stochastics coming down, RSI's down. Yeah, and I would be entering a trade here, but I just wait for this new coming up, like 2 minutes, so taking that sell. On that, as you can see, look, again, I don't get FOMO anymore because you know there's always another trade just around the corner. That's about all there. Nas doing the same. Look, had that little sweet buy and then bang, back down again. There's just so much world news and Elon Musk and everything that's just pull this down against any of the economic data that's coming out. That's got to be wary of, which is the biggest fish. Moving things. Again, set on our trend line. We've got 1 minute 35 left, and then we've got the news. Rise, remember, should go the way of the news again. Wait and see. In there. in. We're on US 30. Check. Again, got my preset levels for TPs. And we've got the countdown. 50 seconds to go. Good luck, everybody.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
You could do $20, $30, but you can only trade gold. That's the thing. Now, 1,500 is a small account in trading, retail trading. It's a small account. Believe you me. Here we go. Right. 53.4. So just slightly worse than expected.
The White House facing
So it's going to get a push down. See.
BlackRock CEO Larry Fink adding just a little bit of fuel to the gloomy outlook.
We're witnessing all these supply shocks, and that's
down.
Attended price increases, and so it's more supply driven. Most of the problems we're living with today are more policy generated and supply generated. There's greater recognition that inflation is not transitory. It is probably with us for a number of years.
Taking the temperature of the mood in Washington, D.C., in the White House and of the country. Down in D.C. is Anne-Marie. Morning, Anne-Marie.
Good morning, John. It's really a rough set of situations for the White House, isn't it? Because at the one
Bouncing
hand, you have this
down again, push down.
again today. But when you look at the polls, and I was just recently re-looking at the one from Gallup earlier this month, when you ask about the state of the economy, very small margins of people think it's actually going in the right direction. And when you start to dig into it, what are their concerns? They say the leadership, inflation, economy in general. Well, that's pretty extraordinary given where we have the unemployment rate at 3.6%. And this all comes down to consumer prices going up. And every day, the White House and advisors in the White House, like
Couple of nice wins on that sell.
are looking at that AAA gas price average yet again today. It's another record high. And it's these issues that are really hurting them.
Brilliant.
Right now.
Go. One loss of $2.39, £2.39, $2.39, but we've got the wins on all those. Nice.
To balance the global oil market, which is already shifting back into deficit following China's demand recovery. They go on to say, we reiterate our second half 125 Brent forecast. They think price risks is to the upside. That's for oil.
We get on that.
Refining capacity issue. For the prices at the pump,
46, 45, here we go. Am I all done?
It's true. So on one hand, and we should separate it, and you're correct to do so, there's the oil market and then there's the refining issue. So when you look at this deal OPEC did, I would say on the diplomatic front, it was a win for the White House. They've been asking since August for OPEC
Beautiful. That was nice and easy.
Saudi Arabia to pump more. This is in August. This is way
Pushing down, we'll go again on the sells if it breaks this level, so just watch out for that.
They've been asking Saudi Arabia to hit the pedal to the metal and really start producing more. And finally, there was a breakthrough. Now, how much oil is actually going to be physically in the market? It's not that Saudi Arabia and UAE, the ones that have the biggest spare capacity,
we managed to get
it is distributed across all of the members.
20, 30, about $40 on that. That was good. Again, we're dealing with a smaller account.
So it's minimal. It's smaller of a supply deal than you would expect, but it does leave the door open. Saudi Arabia already willing to do it. Potentially are going to shun their partner, Russia.
There you go. We're going to get the break. PMI, news. Just sat on our points of interest. Wait.
And right now, those margins are exploding because we don't have the refining capacity. There's a ton of issues regarding this. One, spare capacity for refining is in China. The second, of course, is that this really isn't a Biden administration problem. It's been an American problem. Even before the pandemic, America was not investing in refiners. So now we're left with a place where it's not just oil, but it's turning it into products, and the materials are just not there.
Anne-Marie, AMH in DC, with a clinic on what to look for in this commodity market. JP Morgan,
Wait for it to break this next level and jump in.
Stayed with me. The team over there looking at potential.
PMIs, as you can see, look, worse than expected. We'll just print that into the group. So, see.
Remember the
Still waiting now for the ISM, which are final trades of the trading week for me.
Back with us for a final thought, Sir Badra Ajap and Mike Collins. Mike Collins, given everything you and I with Sir Badra that we've discussed over the last 30 minutes or so, why have spreads tightened so aggressively over the last few weeks, Mike? What's going on?
You know, spreads, Jonathan, went from arguably pretty fully valued, you know, a few months ago to fair value, maybe slightly cheap, and the yield levels have gotten really high, right? And if you just go out today and buy,
Looking good.
You know, a 10 or 20-year treasury at a 3 or 3.40,
10 minutes to the final trade.
Spread stuff on top of that for next.
They've had a really good day. Good NFP, good PMI, good open. Perfect. Like I said, we didn't trade the European or London Open because there was no London market today, so more than made up.
So I think that demand just comes in at
that.
higher levels of spreads, higher levels of yields, and companies are doing okay. The fundamentals are still okay, right? Even if you have a technical recession, I don't think it's going to be an existential credit crisis, and that's a big differentiator.
Mike, do you think this is what the Fed wants to see? Easier financial conditions?
I do worry,
Market
John.
minds, as you can see.
As we talked about how high.
And now we've got the ISM coming.
The Fed will say, "Wow, we're not succeeding."
For some people, is an important one.
And they just keep pushing on it, right? So this is the big battle in the market, this big tug of war. Why it's really tough for the.
We're in this channel. You can see our channel sat on support. So we needed to break this level to be a first sell. It hasn't done so far, so it's just keeping up as well. But again, just wait, just get in that whole position again.
You know, selling a little bit on the margin into this rally.
Equities getting sold this morning. About 20 minutes in, we're down more than 1% on the S&P, on the Nasdaq down 1.9. So, Badra, I'd love your perspective on all of this. Rick Reeder was on with us about an hour ago. He was talking up this scenario that many people agree with, that the equity market can't rally too much, credit can't rally too much, spreads can't tighten too much, because the Fed would perceive that as an unwarranted easing of financial conditions that they'd have to lean against. For someone operating in fixed income, watching the Fed, Sir Badra, what's your perspective on that?
Well, I think that the Fed is looking for a sweet spot, right? They do know that their actions are going to tighten financial conditions. So that is something that is going to automatically happen as they're raising interest rates. What they don't want happening is an extreme tightening of financial conditions that's going to lead to a hard landing, if you will, on the policy front. So they're trying to sort of orchestrate a soft landing. They're okay with it.
I remember we did start the account with $600, so got to this level by trading this week. So, you know, a lot of people, you could just take that money out and restart and reset again next week. That's why I do it. Treat it as a wage. You know, and if you don't win or you're in a loss, then you don't take anything out. And basically, you know, you look to put money back into your account to get it back up to that level. But I always say, of any kind of scalping system, $500 is minimum for you to do consistently well. Yes, you can do it with $20, $30. It's hard because you're limited to what you can trade, which is gold, which is the most volatile of all. Generally gold, I mean, it's few of the brokers will offer lower lot sizes, micros on things, but generally gold's the one that moves enough for you to actually make any money, rather than one pip and you end up making 10 cents a trade. And it takes a long time to get from $20 to, like, you know, 100. You know, that's as big a move as getting, like I've done, 600 to 1500 or whatever. But it just takes a long time. So as long as you're patient, it can be done. I've done it multiple times. Check back through our videos. We've had small trading accounts from $50, $60. We've done it. It can be done. But you've got to get excited about winning cents, pence, rather than dollars. You know, and if you can get excited about winning 50p, 20p, and seeing it as that will be $20, $30, $40 later on down the line, then you can do it. But for most people, they go, oh, is it all? And they give up and they lose focus. They don't treat it like normal trading and they lose it, blow their account. And they want to hurry up, so they enter too bigger lot sizes, obviously get the drawdown, blow their account. And it happens all the time because people ask me, what should I be trading with? And, you know, minimum is 100, really is, but really you want to be 500, as a proven today, this week. You can do it and you can earn, you know, a wage from it, you know, if you know what you're doing. But like I say, below that is very, very risky. Not many people can, you know, compound an account from $20, $30 up.
The last one was in 2018.
It's very hard, very focused, and it takes a long time. But the thing is the drawdown. If you make a mistake with 400 or 500, you could get out of the trade. All right, you might lose $40, $50 or whatever, but you can rebuild that. But if you lose half your account on a $20 account, you're even less likely to boost a $10 account, because you just even got less margin to play with, no matter what your leverage is. So, you know, that's my advice: is go for it, use it as a practice, and if you blow it, you blow it. But really, you're better off practicing on demo, saving your money until you've got a significant level, 500, 600, then go live. That's my advice anyway. That should be giving out my free advice. Take it or not, up to you. But
they're still picking up. They're still clicking in a bigger way for some of these names.
So here we go with the ISM final trade.
Into next week with some inflation.
Appalachia was largely built around the coal industry. If coal is a dying industry, then what does that make us? Who are we then? My vision is Appalachian women and men actually leading in the rebuilding of a greener economy. Bloomberg has believed in us.
Nas also bottomed out and then has had a nice reversal now after that heavy support. So a quick look at gold for everybody. What did gold do? Gold on the open. No surprise. Bang was the buy. Oh, there's your buy open. And the drop. You could take that drawdown, that's what I mean. You see, you'd have got the sell, but you should have followed the RSI and gone for the buy. Which was against the news, and obviously against, because NY US 30 was a buy, so you'd think gold would go the opposite way, and it does, and it did. But you've got to be able to accept the drawdown before you get the results. You get the, you know, there was your entry point, which we found about here. You know, look at that. You could have got 100 pips, 10 pips, whatever. But if you missed it and you were looking for the sell, you'd have to take that as drawdown, and then you'd have got your win to the sell. That's what I mean about having a bigger account, because then if you're convinced this is going to go the opposite way to US 30 and a sell, it did. Okay, it's pushing up now. On the initial open, it did drop, but after clearing out people's pending orders, and this is what the market does. That's why I don't use pending orders. Showing your hand. You haven't got a unique idea. If you put a line there for a pending order for a sell or a buy, whatever, guaranteed there's a million traders all in the same position. Market knows that and knows where to clear out and gain the liquidity, and that's why pending orders just don't work. Not on scalping anyway, maybe on swing trading. Not what we do. Being stealth, being in and out quickly as possible is the way. Multiple trades, not holding too long, getting the money, getting out. That's true scalping. That's the way to beat the markets, or have a good chance of beating them. If you've got a massive account, $100,000, and you can afford to hold while you're losing 5,000, it comes back to you. You know, which obviously very few people. This is good on gold now. Look, there was your initial open, either the buy or the sell, whichever you wanted to go for, and then pushing back up at US 30. Also trying to, so no correlation at the moment. Now we've got the ISM.
26 minutes in, we're down by more than 1% on the S&P, by 1.7% on the Nasdaq 100. That's the price action. Here's the trading diary. The ISM services data coming at the top of the hour. President Biden speaking a little bit later, 10:30 Eastern. PMIs from China over the weekend, an RBA rate decision Tuesday, an ECB and Lagarde news conference next Thursday, and finally, US CPI just around the corner. The median estimate so far, 8.2% from New York. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
The hour. 2 minutes to go, everybody. Good luck. ISM PMI, here we go. A good 2-hour live stream. Perfecto. And we get a final win. 50 seconds. You can see it's pushing up nicely. Predicted to be lower again, like everything at the moment. 56.4. See what we get.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the
17 seconds.
to reach net zero emissions.
Look, everybody.
But Ambani,
We did it again. Yeah, we are.
India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Result. Yet, a spring ready to go is better than expected.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo
Quicker
to
to
find
come
answers
through.
now.
30 looking to pick up. Nothing yet. It's worse than expected. 55. Brilliant. We're done. There you go. In and out. No problem. Didn't even have to look at my screen. Took the sell off that news, and we got 10, 20, 30, 40, 50, $75. There you go. Done. Done, done, done. And that is the end of our trading week. That has been fantastic.
More winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying.
Perfect. That's pushing up, but the initial move was the downside, expected, and that's what I went in for. I just used that, like I say, my preset level of 85 points, 8 pips. It's going to push down, look a little bit more. There it is, look at that. Nice area of resistance. That's great. Good day. We've ended up nearly another 15-16% on our account. Amazing. That is it. Now we're going to celebrate with a beer. We're going to take our profits. You guys can watch the chart. Look at this pullback now, ISM. This is the chart that's done the business for us today. Enjoy your weekend. Like I say, get used to winning cents, because then the cents will become dollars, and the dollars will become tens of dollars and hundreds of dollars. But you just need to be consistent in whichever account size you use. It's just harder because human nature is you want to win and win quick and fast. You know. But thanks for joining me, everybody, on another successful, great NFP trading day. Join me all on the very next one. Live again after the weekend. Going to go and enjoy the rest of the Queen's Jubilee now. It's the bank holiday. And time for beers on the seafront. Celebrate our nice little win on the trading account. Like I say, taking all the way from $600 up to 17. So well happy with that. So yeah, take care everybody. Thank you for joining me. Hit that like button if you like what we're doing. Share, tell people, you know, you can win with true scalping. You just got to learn, be consistent, practice. Yeah, if you want to join the group, then you go to www.mohawkforex.com, where you can find out how to join our group and have me and the team as your mentors. But until the next session, trade safe. Have a good weekend, everybody. Have a good Jubilee to everyone in the UK. Let's go and drink, celebrate 70 years on the throne, and we'll catch you all on Monday for the Euro and London Open. Until then, take care.